Here's 50 years of silver history. And the first, on the left side, you see the peak in 1980 where it got up to $50. And what we've done there is we've marked the spot about 2 quarters or 5 to 6 months before its actual peak, where it went vertical. Which rather, it had been going up for a couple years incrementally, and then suddenly went berserk. Okay. And it was all compressed in a matter of a couple quarters. Okay. We marked that spot with the red horizontal arrow where it began at the top at $50, the red horizontal. And then we put an arrow to measure the distance, logarithmic scaled. Okay. Let's go over to 2011 now. That's the green arrow. And that's where it started with the lower horizontal green line and ended at $50 again with the green horizontal upper line. And we marked the arrow to show the distance of the logarithmic scale to swing. We don't pay much attention to that 50 level except to look back and chuckle. Copper's above its 2011 high and its 1980 high. Silver made two highs roughly around 50 in 1980 and 2011. Okay. Gold's above its 2011 high. Heck, I can find you a bunch of base metals that are above their 2011 high, yet silver's a dog and needs to stay in the hole, right? Okay. There's a mistake been made. Markets often make excessive mistakes, both upside excess, bubbles, so forth. And then when they break, people say, why did it happen? Well, it happened because of what it did, not because of what's going to happen to it, but what it did already. That was an error. An investment error, an analyst error over the years. They underestimated or overestimated. Silver's been capped in real dollar terms so low, because if you take, silver was $50 in 1980 and was near $50 in 2011, and it's still below there now in real dollar terms. Remember, the dollar degrades because it increases in supply about 90% every decade. The quantity of paper, okay. Therefore, it's sort of a junior version of the Weimar Republic, okay. Not quite as bad as Venezuela, but it's ongoing and it persistent. That's why gold continues up, over the decades. In 1980, what was it? Couple hundred, $800. Okay, now it's 3,500, 3,900. Excuse me. Silver's way behind. Okay, now the question is it justified or is it not? And, fundamentally, we can make arguments that, no, it's fully unjustified. It should be a lot higher. We don't pay attention to that. Yeah, there are fundamental reasons why it should be. We pay attention to its technicals. And we've observed, there's a chart we want to show. It's a ratio scaled price chart, meaning log scale, where it's not arithmetic, $10 to 20 is the same as 20 to 40. Instead, it's, going from 10 to 100 is the same as 100 to 1,000 in terms of ratio. Okay.
Markets routinely overshoot both to the upside and downside, and silver's history is littered with analytical misjudgments. Analysts have alternately undervalued and overvalued it, failing to account for nonlinear moves. In inflation-adjusted terms, silver's peaks in 1980, 50, and 2011 $50 are still distant goals today. Meanwhile, accelerating money supply and weakening currencies have lifted gold far beyond its prior milestones. These divergences suggest that past assumptions about silver's ceiling may have been deeply flawed, and that conventional valuation models may miss latent upside.
Here's 50 years of silver history. And the first, on the left side, you see the peak in 1980 where it got up to $50. And what we've done there is we've marked the spot about 2 quarters or 5 to 6 months before its actual peak, where it went vertical. Which rather, it had been going up for a couple years incrementally, and then suddenly went berserk. Okay. And it was all compressed in a matter of a couple quarters. Okay. We marked that spot with the red horizontal arrow where it began at the top at $50, the red horizontal. And then we put an arrow to measure the distance, logarithmic scaled. Okay, let's go over to 2011 now. That's the green arrow. And that's where it started with the lower horizontal green line and ended at $50 again with the green horizontal upper line. And we marked the arrow to show the distance of the logarithmic scale to swing that again occurred in a matter of a couple quarters. Why did suddenly, in those two situations, silver had been a bull market for a couple years, more than that even in the 2010 situation, did it go berserk? Why did it do that? Because it was already in an uptrend. It wasn't like, oh, it just broke out into an uptrend. No, it was already in an uptrend. We found an argument that we make that we're in the same position right now prior to the berserk vertical move. If at current price levels, which is the bottom of both the arrows on the extreme right, the red arrow and the green arrow.
Plotting silver on a logarithmic scale reveals repeated patterns, gradual uptrend followed by sudden vertical blow-off phases. In 1980 and again in 2011, the metal shifted from years of incremental gains to parabolic run-ups in mere quarters. We identify specific thresholds, horizontal levels where momentum shifted, marking the onset of each blow-off. Today's price structure bears resemblance to those precursors. If silver is poised to repeat history, these zones may again become launch pads. The question is not whether it will move, but when it will cross its ignition line.
If we match what happened in the final couple quarters of the 2010-11 bull, then the green arrow says we're going to exceed 100 in the next couple quarters. If you match what happened in 1980, it was like a summer of 79 through 80, that move, again, a couple quarters, you can go to about 200. Okay, now, sounds crazy, right? Okay, maybe it is. First off, if you ever get back to 50, and I know there's sellers who'll be in front of that trying to sell it and risk the buck, you're not going to stop. Okay, it's ridiculous old highs anyway, because in real dollar terms, there's no comparison to where we are now. We're way below those levels. We'd have to go to $200 to match them. Okay, now flip to the next page. Okay, now this is what you're looking at on the top chart here, is how well has silver done or not done month by month close in relation to an ounce of gold. Back in 2020, before that surge in silver where it went from $15 to $30 in a matter of 6 months, the spread was under 0.9% of the price of gold. It's less than 1% of the price of gold per ounce. In 6 months, it surged up to over 1.5%. Well, that's like a 60% gain, boom, that quickly. And of course, the price doubled in silver, and gold didn't double. It went up to $600, but was like a third or something. So the spread shot up strongly. But since that 2021 high reading,
A critical gauge is the silver to gold ratio, the share price of silver relative to gold. In recent years, that spread has compressed, signifying underperformance. Momentum indicators comparing monthly closings to moving averages suggest that momentum is now turning upward. In 2025, silver has regained some ground and breached a descending trend line in that spread ratio, nudging toward a breakout. If momentum continues, silver could begin catching up to gold's pace, a shift that historically precedes strong silver rallies.
silver's performance has staircased back down and underperformed gold. No, silver's risen all during that time, but at a far lesser pace than has gold, net price-wise. So the spread has deteriorated. In April, we turned up. The spread made a low under 1% again, very low level for silver versus gold, extremely low, and has surged. And as of the end of last month, we surged up and broke slightly out above a 2-point downtrend line on the spread, the black line. Okay, nice, great. We prefer it to take out the red horizontal line that's up there just above 1.3%. Right now, silver's about 1.23% of the price of an ounce of gold. So go up and take out that 1.31 double top, and you'll have a triple top breakout on the spread, which will indicate breakout. Okay. Now, the chart below is a momentum chart of the spread chart. All we do on this momentum chart is we measure each month spread close, where is it in relationship to the 10-month moving average of the spread? Above it or below it? Okay, so above the zero line, below the zero line.
In both past surges, the spread between silver and gold exploded just before silver went vertical. In 2010-11, silver leapt from roughly $22 in 6 months after a spread breakout in late 2010. In 1979-80, it performed even more violently. The pattern is clear. Once the ratio cracks resistance, silver often accelerates dramatically. We appear to be entering that zone again. The same structural relationships, trend setups, and technical cues are aligning, suggesting we may stand at the brink of a comparable phase.
It also has been behaving in a degrading manner since 2021, 2020 area. And you've surged on momentum, and now you're up to the actual horizontal line. The spread is not, but the momentum is. So momentum is telling us, hey, I'm breaking out. Okay. And I bet you the spread will follow, because almost always it will. And when that momentum clearly breaks out over the top of that spread, its resistance, the red line, excuse me, the spread will join. And when that occurs, flip to the next page. Let's go back in time now, again to that surge in 2010 through 11, where silver went from like $22 to 50 in 6 months. Okay. The top chart is a spread chart. Again, month to month, where is silver in relation to gold on a percentage basis? And you can see that for a couple of years, it was capped at about 1.6%. It couldn't get above there. It finally closed above it in September of 2010. Okay. Look what happened in the next 6 months into the spread. It doubled, went over 3%. But look what happened to price at that time. The second chart is silver monthly bar chart of price. We've circled the month where the spread broke out.
Looking ahead, silver may revisit prices of $100 or even $200 in a full parabolic blow-off, not to match nominal highs, but to match them in inflation-adjusted or ratio terms. Nearer-term resistance zones near $50 loom. If it clears those, the path upwards opens dramatically. On the flip side, failure to break out might lead to a pause or pullback. External pressures, monetary policy, industrial demand, supply dynamics will act as accelerants or constraints. But structurally and technically, silver is poised for a defining chapter in its long history.
The top chart. Again, that was September of 2010. Look what happened in the next 6 months. Huge surge, fake out drop, and then the next surge. But in 6 months, you went to $50 from 22 something. Okay. Now look at what happened to gold price during that time. It went up too, but hardly of the dimension that silver did. This exact same thing happened back in 1979 to 80 when silver went from the, off the page. On a log scale, even more than the 2010-11 surge. The spread broke out. That was the technical indicator that not only are you in an uptrend, which we already know, silver and gold already in an uptrend, so it's no big deal. What causes them to go vertical is when this spread broke out. And we're at the cusp of that right now. In fact, I'm betting this month does it clearly in terms of the spread breakout. But this is what happened back in 2008, 9, 10, and 11. Late 2010 through early 2011, silver went berserk while gold continued up. And I think we're literally at that door. So the most important technical to look at now for the monetary metals is the spread. And it's a table pounder because obviously if you do either one of those log ratio moves that we had in 2011 or we had in 1980, silver goes to 100 to 200 just to match either of those.